A very good a very good evening to one and all, respected members, the managing committee of Thane branch, our honorable speakers and everybody. So as we all know that union budget was presented a couple of days back on 1st of February, and there were a lot of changes. You must have gone through the union budget document. It is some 200 pages long document. We have aimed at finding a good speakers for a direct indirect tax, as well as certain few new concepts that are being introduced, such as virtual assets. They have specifically mentioned what is NFT, Bitcoin and everything in the upcoming taxation scheme. So it is important for us as chartered accountants and consultants to businesses and other individuals to be to know all the concepts thoroughly before advising them on the taxation matters. So that's why we have with us our honorable speaker, Mr. Nikhil Mahadeshwar, who is also a cybersecurity expert, as well as CA Karthik Natarajan sir, who will be briefing us on the taxation aspects of NFT and other direct tax amendments proposed in the union budget. Now I ask our honorable chairman Asawa ji to speak a few words.
Harshvardhan, respected proceed. Let me congratulate all newly elected MCM of Thane branch, Harshvardhan Bapat, Omkar Gadgil, Palak Tikmani, Chetan Bhai, OP Singh, Rajnish Sharma, Swapnil Kolte, and out of them, I think Harshvardhan, Omkar, Palak, Chetan Bhai, and OP Singh is present here. Today, today we have two such newly elected members. Namely Harshvardhan and Omkar Gadgil, will take you through the entire duration of this seminar on Budget 22. My sincere thanks to both of them to take entire responsibility, be it selection of speaker, coordination with them, all so was managed by these two gentlemen, Harshvardhan Bapat and Omkar Gadgil. And today we have extinguished speaker, Mr. Nikhil Mahadeshwar, and CA Karthik Natarajan sir, who will deal with the given subject in details. Before I end, a few announcements. Tomorrow we have 2-hour CP seminar on new generation audit tools and technique by RCM CA Murtuja Kanchwala, 5 to 7 p.m. And day after tomorrow on Sunday, that is by CA Anil Bhandari, and his subject will be how to 10x your practice, or basically he will be guiding through us how to sell yourself. So we have given name how to 10x your practice. That will be at 11 to 1 p.m. on Sunday. And secondly, once again, my gentle reminder to all of you who are into meeting room, change your Zoom name as membership number followed by name. Please do not blame us if we could not able to upload your CP credit. Over to you, Harshvardhan.
Thank you so much, sir. I request CA Omkar Gadgil to introduce our first speaker, Mr. Nikhil Mahadeshwar. Omkar.
Thank you, Harshvardhan. Yeah, am I audible, Harshvardhan?
Yes.
Yes.
Yes. A very good evening to all the Thane branch members. Thank you, Asami ji, for the kind words of appreciation. Thank you, Harshvardhan, and all the a very good evening to all the members, to all the managing committee members. So we have today a very interesting topic, first of all, for the discussion post the budget. Now, I see a bit of change in this, the approach that we have put it up right now, because virtual assets are the future, as it has been emphasized by the Honorable Finance Minister in the budget speech. So the virtual digital assets, and everybody was very much waiting for this cryptocurrency things to come up. So we have a very, very highly experienced and a very perfect candidate to explain us the nitty-gritties of the entire things about this. So first of all, I would heartily welcome Mr. Nikhil Mahadeshwar. So Nikhil is the co-founder of CTO Skynet Softech Private Limited. Currently, he is holding the position of the CTO in this company. Nikhil has a huge recognition and a huge set of recognition and achievements by in his name. Nikhil ji has been a very regular speaker or a very regular contributor in various press releases, in beg your pardon, in various press notes, in media, in TV channels, on the YouTube channels, and the list moves on. He is an active contributor to the cybersecurity space, created an initiative called Cyber Secured India. Under this project, he has trained hundreds of practitioners against continually evolving cyber threats. He's been recognized or he has attained various recognitions from various publications and institutions for his work in this area. He has specification and he has experience in the areas of ethical hacking and information security. He has demonstrated multiple live mobile hacking in Gulf Information Security Expo and conference in Dubai. And I believe this in itself speaks the volumes of his experiences. Other contemporary issues within the cybersecurity space and digital privacy. Nikhil has the unique distinction of having trained more than 50,000 people, and I believe we have the added numbers in it, so that is truly fabulous. He is a top-line cybersecurity consultant with corporates and law enforcement agency. He is currently the member of cyber attack community at the Asian School of Cyber Laws. He is visiting faculty for the Maharashtra Entrepreneurship Development Program of the Maharashtra government. He is invited frequently as a lecturer by the engineering colleges and the management institutes, law colleges, and cybersecurity institutions. He has been recognized as the youngest entrepreneur by the MBC. He is on the linkage and advisory committee of his institution from where he has obtained a degree, Shadashram Vidya Mandir, Tantric Vidyalaya and Junior College. With these words and the huge set of experience and the excitement that we are going to have such a great faculty for us to guide us through this topic, I welcome Mr. Nikhil to this session. Thank you. Over to you, Harshvardhan.
Thank you, Omkar, for the introduction. Now I request Nikhil to take the center stage, please. Nikhil.
Thank you very much, sir, for the introduction, and thank you very much, first of all, everyone, for inviting me for this topic. And today, so special thanks to Harshvardhan sir also. So today I will be sharing with you about NFT and virtual assets. So what we'll do is we'll cover up some theory, and then I'll actually demonstrate you which are the sites where you can basically do exchange, which are the sites where you can buy some NFT, and what are the scams basically which happen in this NFC trade, and how you can protect yourself from not being a victim of this. So I'll just share my screen. Just someone has to just tell me if it is visible.
Yes, visible, Nikhil.
Thank you. So let us start with what exactly is a virtual asset, and what is NFT. So I'll just share some definitions as a theory part, and then we'll move to the practical part of it. So virtual asset is the digital representation of value that can be digitally traded or transferred, or can be used for the payment or investment purposes. Like Bitcoin is there, Ethereum is there, Tron is there, and there are now lots of virtual assets into the market. So like I remember when Bitcoin trading started, or this type of Ethereum trading started. So like I'll just share my another screen, and I'll show you when it started, what was the price of it, and how fast it has grown and captured the market. and the people who have actually invested. So let me just show you. So if you see the price, let's say when 1 year ago it was 1,16,000, and today if we basically see it is 2,11,000 and all. And if we see like 5 years down the line, it started with 770 and all. So if we go into INR calculation, ETH to INR, and again same goes with Bitcoin as well. Let us show you. 5 year down the line, 1 year down the line, if you see. So these are what the prices are, and since it started and how it is growing day by day. So actually NFT, so non-fungible token. So basically it stands for non-fungible token. I'll just make the definition more easy for you. First, let us understand what the token means, and what does digital or virtual asset basically mean. So like if I pay you, I want to purchase we can say a book or any type of item for which is worth rupees 100 or worth rupees 1,000. So we just have to replace that rupees into token. So I'll just give you one more example of token also. When you do some digital payments, so you just scan UPI ID, and or you just scan the QR code and enter your UPI pin, and within fraction of seconds the payment is transferred from one account to another account. So basically it is again a token based transaction. There are lots of we can say activities, database APIs hitting at the background, and that is again there is where token is also used. And here the clear definition is a token is a digital representation for any type of goods or service written into the blockchain. So basically it is completely related to blockchain. And as I just give you an example, so it maybe you can consider as 100 rupees at 100 tokens. And again the value of it, how it will be showing you in the upcoming slides. So what is the difference basically between this non-fungible token and cryptocurrencies? So what the just I just I'll just tell you, for the better understanding, we'll replace this word fungible to, we can say, replacement, or we can say non-replaceable. Okay, so we'll say non-replaceable token. Let's say you purchase a book. Okay, you are chartered accountants and you read lots of books. So if you purchase a book by a specific author and of a specific edition, that same book is available at the Amazon bookstore, or we can say Kindle, or the same book is available at the offline store as well. But whatever is your copy is your copy. The same copy is available, I understand, but you make your notings there. You note down with your pencil or pen. You add bookmarks to it. So you fold a specific page for a specific note. So now the book which is available in the store and your book copy are not same. You have a copy which has your own notings, your own notes and everything. So that is what is an example of non-replaceable token. So whatever you have is unique. So using the NFT, you just have to, whatever you buy is unique. There is no other copy of it. And basically it is NFT, they are bought using Ethereum only. Also the other currencies also are basically they accept, but just have to check using the platforms. So we are going to see the platforms live demonstrations as well. The difference between NFT and cryptocurrencies are like, if you see the second para, so cryptocurrencies are like same. Like let's say I have 5 bitcoins, you also have 5 bitcoins. So there is no such uniqueness. So today, whatever is the rate of Bitcoin, it applies to you also, and it applies to me also. So NFTs are basically different, and cryptocurrencies are different. So that's why we can differentiate this as NFTs and digital assets or cryptocurrencies here. So if you just replace the word fungible, like to from non-fungible tokens to non-replaceable tokens, that would be very easy for the understanding perspective of it. So as I told you, they are like built by Ethereum-based blockchain, and the other currencies are also supported, but majorly Ethereum is recommended. And it was first created by Kevin McAfee and Anil Dash in May 2014. So from there, there is a history of, we can say, NFTs, and if you are more interested into it, you can just go on Wikipedia and read about it, the history and everything. So what is it actually used for? So majorly digital art, for exchange of games, music, films, and money laundering. Why I say here money laundering is, let's say you want to exchange money, and now you have to show some exchange. So let's say if there is a digital art, and it doesn't has any worth, or let's say it has a less worth, so you can actually raise the price in whatever numbers you want, and basically show it as an exchange for what you're purchasing it, and for why you're purchasing that. You only know, and the other party knows where you're lending the money and wherever you're purchasing it. So digital art, and these all are unique things. As I told you, it is non-replaceable. So there is no, we can say, duplicate thing available over this. So wherever there is a duplicate thing available, if you found so, then it may be a scam. Or as I really told you, that there are lots of scams also which happen into this NFT and digital assets world. So we'll focus on that also once we go for the demonstration part. So this musics also, films also, it's sort of a, we can say, I if I own some art and I wanted to sell it, I can sell it using NFT. Or if I own some games, I can sell it using NFT. So, and the, we can say, the rights of it remains with you. And also there is a resale available. Let's say if I purchase it for a 1 NFT or 2.5 NFT, I can just give a resell it for 3 NFTs or 5 NFTs or 10 NFTs, and that price is what I can decide. And also you will be able to look at the history of who has hosted that NFT, and since when that NFT, sorry, who has hosted that art, and since when that art is hosted, and what are the dimensions of it, and everything. Similarly, it goes for games also, musics also. And so basically, who are these people? These are the creators, and we can say owners of this type of arts and music and games. And there are lots of things which are sold. Also, once you basically joined, you purchase it using NFT, they allow you to join the Discord group. So now nowadays, WhatsApp and all we all are using, but Discord is in trending, and there are lots of Discord channels basically, where there are lots of offers, legal, illegal purchase and sales, and lots of things. So if you like purchase anything, you are allowed to join their Discord channel, and there are lots of peoples or and members who do a lot of exchange using this NFTs and digital currencies. And there is why people, one of the reason, or one of the major reason, I would say, people do trading using NFTs. They get their desired group basically to join the Discord channel. Okay. So these are some of the clip arts basically where people purchase something. and how does just it look like. And there are different type of tokens also. So fungible tokens, it is mentioned as ERC20, ERC2 to 3 is improved fungible token, and the NFT specifically, that is non-fungible token, is ERC721, and token which is used to transfer the funds basically is ERC777. And obviously the copyright also will be transferred if somebody purchases anything, so that it is used as ERC1190. You can buy your own NFT by using OpenSea, Super Rare, and Nifty Gateway. So I'll just share my another screen and let us see how you can purchase NFT, and let me actually demonstrate you how it works. I am actually demonstrating you very limited platforms because there are many. I'm just demonstrating you, we can say, well-known one, and actually how you can use it from the scratch. I'll demonstrate. So again, more than presentation, I am actually always a demonstration type of guy. I hope you are able to look at my browser. So MetaMask is one of the crypto wallet basically for all type of we can say blockchain apps. Here is how you can just start with the NFT thing, and it is available on Google Chrome, iOS, and Android. So just it is recommended to use Chrome for viewing it completely. Just you have to click here and go and install a Chrome extension. Now here also you have to make sure you are going on metamask.io, not on metamask.com, or we can say how people basically con is, I'll tell you, they change the spelling of MetaMask or any type of similar NFT, we can say trading things, and this is how people basically con you. So there are lots of people who have already lost crores and crores of rupees, and I don't know in the terms of we can say digital currency in terms of ETH, but in the terms of rupees, if I'll tell you, crores and crores of rupees just because of clicking on a wrong link. So make sure you download it from metamask.io, which has again a SSL and everything. And once you download it, click on install on Chrome. If you are on iOS and Android, you can try this as well. So once you click on add to Chrome, it will check for vulnerabilities, and then it will, okay, if it is safe, you just add. So it really depends on your connectivity and speed as well also. Okay. Okay, so it's added, and now see you get other extensions as well here. So okay, it's added now here. Actually, I'm getting the pop-up again and again that people are in the waiting room, and that is the reason I'm not able to move my cursor. Just give me a minute. Okay, just let me stop my screen share, and I'll just give me a minute. Okay, sorry, I think there is some extension issue. I'll again share my screen, and you just can go through the site of metamask.io and check it. So sometime it happens like your browser supports or does not support. So it was running on my browser. I just removed it to show you the complete step-by-step demonstration, and it is giving some compatibility issue. So you guys can check it over your Google Chrome browser or your iOS and Android. Okay, so MetaMask is one of the prerequisites or any of the, we can say, crypto wallet. So to purchase any NFTs and everything, you need to have a we can say crypto wallet, and where you can add your ETHs, and you can basically do exchange of ETHs also, like on Etherscan.io. You can check the current rate and do the exchanges. And also, as I showed you, what are the prices today, and that is also you can check. Now, where you will you spend this type of even if you have ETH into your wallet, where will you spend this? So I'll just show you. So this is also one of the best marketplace. So when we say we have money in our wallet, we go to the market and we purchase something. So here is how you can basically go in. OpenSea.io is one of the best, as I showed you in the presentation. And OpenSea.io, if you go, and you can actually explore what type of collections, domain names, music, photography, sports, anything you can. So let's say I'll go to photography type of thing, or all NFTs, where all NFTs are, we can say, accepted. And also you can place a bid. Let's say if the price which is given by the owner or the person who has uploaded it, so if you are not okay with that price, you just can give a bid, and if the person accepts it, the who has hosted it can basically approve it or disapprove it, whatever the deal is. So OpenSea.io is one of it. Then I'll show you. Okay. Super rare. So super rare.io basically is one of it. And again, here you have to select the wallet. Once you click on select wallet, again, like MetaMask, there is Fortmatic, Wallet Connect, and many more are there. But make sure whenever you go for any type of exchange, or when you purchase any type of NFTs, these are compatible with cross platforms like Super Rare, we can say OpenSea, or there are lots of types of, we can say, one of it is again Nifty Gateway. So here also you can check. So in OpenSea, let us see whatever is basically loaded. So this is a domain which they are selling. So again, if you see, people sell here domains, arts, and other collections, whatever it is available. Now the total bid price is 0.0028 H, and which is worth $7.50. And you can actually see who has created it, and you can actually see at what price it was purchased, by whom, and when it was resale, and now when it is again available for a resale. And also you can check the other details of it about the person who has uploaded it. Now here you can actually apply a filter and see how the other people who have bid for it and everything. I'm sorry, this is I think my connectivity, or I don't know, but the sites are not loading here. Maybe you can try at your end, and it will basically load. All right. Also, you can buy or sell ads here, and you can for I also a QR code is generated once you're into the wallet. A QR code is generated, and QR code is unique, so you get a address basically, and the address, it's like a UPI ID. Your UPI ID is unique. So if I want to transfer money into your UPI ID, I just enter your UPI ID and I transfer it. So similarly, you get the Ethereum address, and using that you can basically transfer the UPI ID. I'll just check if we get some reference image for it. Okay, so I've got it, and I'll just share my screen again. Okay, So if you are able to see this, so this is your wallet address, and there's a QR code where you can actually give a QR code to scan somebody, and they can transfer you whatever they want to transfer it, and whatever your trade is specifically. And the wallet address again is, as I told you, unique. It's like your we can say a unique UPI ID, and they can transfer the digital currency here. And there is again a platform fee which is charged. So if you go and market on OpenSea, or we can say Super Rare, or any type of other platforms also, so they just charge a, we can say, wallet fee. And the wallet sorry, we can say a platform fee. And the platform fee we have to pay, and also the owner gets other other credits also from there. So let's say if there is something of 1 Ethereum, so a platform fee is also charged, which the buyer has to pay. And this is how the complete trade works. So just to sum up, so NFT is non-fungible token, and so it is again, the unique things are bought on the marketplaces like OpenSea and SuperRed, and you can install it via your Google Chrome extension. And MetaMask.io is one of the we can say well-known and best wallet. But I don't actually, it is not working over my Chrome as of now. Maybe some issue with my Google Chrome browser. So, all right. So I am basically open for any type of questions if you have over this live demonstration.
Nikhil, Harshvardhan here.
Yes.
So, just to clarify to all the members also, so can you just tell us what is the exact stand of the government on this NFT trading or Bitcoin trading that they have recently declared?
So the tax which is declared by the government. So let's say if I send you some sort of we can say digital currency, maybe NFTs, maybe it may be Bitcoins, maybe ETH currencies, Ethereum or anything. So it will be considered as an income at your end, and basically it will be taxable for you. So till now,
Correct. But,
whoever
see, the main thing is we are not aware of the identity of the other person to whom we are transferring.
exactly.
And there are certain provisions as 1% TDS and things like that. So do you expect that such identity disclosures will be mandated by the government in the future?
So even if such identity disclosures will be mandated, even if it will be mandated, again, it is not. See, these platforms basically are intended to be anonymous, and anonymity is the specialization of such platforms. So there will be, again, we can say there will be again ways where this anonymity will be continued, and if it will be mandated. Then people won't use such type of platform. So there is a possibility that government may mandate, but as you rightly asked, that we don't know to whom we are sending the ETH coins or Bitcoins or whatever. And till now, that is the reason this digital currencies were used for extortion type of purposes also. Let's say if there is a ransom attack, the attacker would, we can say, demand Bitcoins, and that was the anonymity was the only reason why the attacker was using or trading into Bitcoins, so that they should not get a trace back. So here the identity disclosure again is a question. So they may ask or they may demand for it, but if it happens, like, people will stop using this type of platform.
Members, any questions?
Good evening.
Good evening, sir.
Nikhil, I have got one question
Yes.
that how the digital rupee is going to be different than the cryptocurrency, because what I feel is there is a lot of difference in the rupee which will be recognized by the RBI, in which the future dealings will take place. So how it has got a we can say the difference between with the cryptocurrency.
See again, as rightly mentioned by Alshavardhan sir also. So cryptocurrency is again something like to whom I am paying it. The anonymity remains here, and in digital currency, I will be knowing basically to whom I am paying it. That is the major difference here. That you will be able to identify the we can say this the buyer or the seller, or we can say here the receiver or the sender. That is the major difference here.
Thank you.
And now currently regular but will be RBI will be top of them to again govern, or we can say have a supervisory look.
Good evening. I have one question to ask. My name is Anil Kurmi. Okay, now we are saying this crypto transactions are based on anonymity. We don't know who is the buyer. So now, if we deal in this crypto, and if you buy anything, and if you want to deduct TDS, and we don't know who is the buyer, then how are we going to deduct the TDS and submit to the government? So don't you think that till the time there is a clarity on this, or till the time there is certain amendment to the crypto, okay, where they provide clarity that how this transaction should happen, we should not be advocating crypto in this forum? Or maybe is it right to transact in crypto now, as of now, in absence of any clarity from either the government or from the crypto people?
So, as you rightly said, see, there is no clarity, and obviously there are lots of confusions. Like because this is anonymous and you cannot deduct TDS and everything. But the receiver, let's say, if I am receiving any type of digital currency here, let's say if you send me some Bitcoin, so it is received as an income for me. So I have to basically pay the tax, and the part of TDS deduction is really a confusing thing. I will not be able to comment anything on that.
Okay, thank you.
Right. If there are no more questions, then shall we proceed?
I just have one suggestion here that whatever the sites are, like mentioned, I can put them into the chat box also. So if you want, you can just try it. I'm not saying by buying it, but you can just go to the sites and try it. So should I put that into the chat box?
Sure, Nikhil. At least we can just view those sites at least.
Exactly. You can, yeah, and you can go to the information as well.
Yeah.
Yes.
So
So one I have. Okay. These are the two major. One is the marketplace, and one is the we can say wallet, where you can buy or sell the ETHs or NFTs.
Right. So thank you, Nikhil, so much for your valuable inputs, and not just inputs. You practically showed us that how these sites look like, what these sites are. And I thank you from on behalf of the Thane branch and all the members who are attending right now for your valuable inputs.
Thank you very much.
Yes. So, Karthik sir, you're online.
Yes, please.
Yes. So, members, after Nikhil's valuable inputs on what exactly is NFT, the practical demonstration, I would like to request Honorable CA Karthik Natarajan sir to guide us as to the direct tax provisions proposed in the Union Budget 2022 on these NFTs and other direct tax matters. And I would like to request Omkar to introduce the speaker, please. Omkar. Omkar. All right. I'll introduce Natarajan sir right now. Natarajan sir, am I audible, sir? Am I audible, sir?
Yeah, you are.
Yeah. So, Natarajan sir is a member of the International Taxation Committee of ICAI and also a fellow member of the Institute of Chartered Accountants of India, focusing mainly on direct and indirect tax litigation space, performance evaluation, regulatory FEMA, Benami Act, Black Money Act, and insolvency law. He has worked experience for more than 22 years and operates from Mumbai and Chennai, and also has wide-ranging corporate work, having served in responsible positions in Societe Generale, Sulzer India, Elpro International. Karthik sir is a prolific contributor to public tax policy, having provided oral evidence before the Honorable Parliamentary Standing Committee on Finance on the introduction and content of the Benami law itself. Besides, he has published many articles in leading newspapers and online publications. And I personally know that he has been a great speaker in European conferences on the international law as well. So this is just a brief introduction, and I request Karthik sir to take the stage, please.
So, namaskar and good evening, ladies and gentlemen and professional colleagues. Thank you for the kind words of introduction, CA Harshvardhan. Respected CA Shiv Bhagwan ji, Chairman, Thane Branch, CA Rajnish Sharma ji, CA Swapnil Kulte, CA Suren Thakur Desai, CA Harshvardhan, CA Omkar, and the newly elected office bearers of Thane Branch. Thank you so much for the opportunity provided to me to share my analysis and my views on the recent budget proposals envisaged in the Union Budget 2022. This will be reflected by way of Finance Bill 2020-22 to be taken up for detailed discussion by the Honorable Legislature, Parliament, and thereafter it will become a law once it is assented to by the Honorable President of India. Next slide, please, Ronnie. Friends, tax practitioners especially tend to view the union budget through a narrow prism of tax. No doubt tax is an important consideration. However, there are several macroeconomic factors which are considered in the budget making process. Ultimately, what is a budget? A budget is a balancing act between receipts and payments. So perhaps the governmental expenditure is budgeted first. What are the grants that are required by various ministries for various programs of the government? And government has so many socio-economic objectives to it. It's a welfare state. And then perhaps revenue is sought to be augmented through various modes, taxation being one of the key ones. Inter-borrowings, governmental borrowings are all others. But taxation remains one of the key aspects we tend to look through. The budget framers, when they may have started the exercise, which has culminated in the union budget presentation February 1, so they have had to factor so many variables in front of them, chief among them. From a domestic perspective, kindly remember the pandemic year just went by and recovery green shoots are emerging. So there will be a challenge as to which sectors need motivation, which sectors need encouragement, in what phase, how can we do it, etc. Friends, remember, Honorable Prime Minister of India had announced the goal of India targeting to achieve $5 trillion economy by 2025. Today we are the 6th largest with $2.97 billion US. We were 5th. UK overtook us during the pandemic year. And now, with the pandemic applying its nefarious brakes, perhaps we may reach the very vaulted and ambitious target, $5 billion economy, GDP, maybe by another couple of years. We are almost $3 billion US now. And when that happens, we would have overtaken United Kingdom, who's just before us, Germany, and Japan. That would leave us to compete with China, who's currently at $17 billion US, and USA, which is $24 billion US. So that's quite an ambitious target. And so how to achieve it? This budget has given a growth kind of a vision. So we are at 75 years of independence right now. So perhaps the next 25 years, 100 years, how do we achieve? Perhaps this budget may be seen as laying some kind of a blueprint. We are also aware that owing to security and defense needs, that would also put a lot of budget pressure on the need for expenditure, especially defense expenditure of the capital kind, perhaps. So that again would have been top of mind for the budget framers. Also, certain elections are around the corner, so any major tinkering, especially of the bold reform type, could have been immediately latched on to by the opposition to say that the government is not a populist one. So these are the trials and tribulations which the budget framers would have had to go through. Similarly, on the international side, we now are facing through widespread inflation. For instance, USA is reporting almost 40 years the maximum inflation possible. Primarily because during the pandemic, factories had shut shop, resulting in supply constraints. But demand is now tremendously picked up. Demand was there, demand is now going back to the pre-levels with the opening up. And then that supply-demand gap is putting pressures, and that causes inflation. India is also facing inflation. Similarly, there is a lot of unrest globally. Today you have wars going on in Syria, Iraq, Middle East is, we saw the attack on the Abu Dhabi airport. Middle East is in turmoil. Russia-Ukraine crisis is brewing. So as a result of all this global tumult, the oil price, which is a very important factor for our budget framers, because we have to budget. Oil is one of the major imports, and that's one of the key aspects of our expenditure. Today, oil is almost at $90 per barrel. So oil price is under tremendous pressure. Similarly, look at even from our favorite item, tax. What is the challenges? India is, though not a part of the OECD, but we are definitely a part of G20. And so collectively, we have launched the base erosion and profit shifting project, BEPS project, as we know. And there is a couple of pillars, very important, pillar 1 and pillar 2. So pillar 1, quickly, where will major big multinationals, where are they supposed to pay taxes? How are the taxing rights going to be allocated? That's pillar 1. Pillar 2, all the signatory nations collectively aim to have a uniform corporate tax regime of 15%, so that the tax rate or tax slab arbitrage is taken away. That also we have to respect. We are currently around 22% at the lower rate. Going into this budget, the budget framers were aware there is this crypto, and cryptocurrencies have now picked up steam in the economy. And there was not much time the government could now delay any decision on whether to approve, legalize. Interestingly, I will talk about it at a later point. However, this budget is one step forward to legalizing crypto. I heard the discussion just before I came on the dais. So this budget is one step in that direction. Similarly, we have already launched a war against black money, and therefore how to continue that, what are the steps that are needed, etc., etc. So growth, revenue mobilization, and keeping the momentum in terms of not tinkering too much so as to give us stability. That seems to be the, those are the top considerations perhaps before the budget framers as they went in. Next slide, please. So with that backdrop, friends, you will recollect this quote which Madam Finance Minister quoted at the beginning of her budget speech. And India is a welfare state. So while framing laws and while preparing budget, etc., friends, most of us would think in terms of linear terms of tax being a top component. However, by personal anecdotal experience, I can tell that when it comes to lawmaking, the Honorable Legislature has to be alive to the requirements of even the starting point in the economy. It could be any person at the bottom of the economic chain, could be a bus conductor, could be a trader, could be a multimillionaire businessman. For legislature, honorable legislature, they have to be alive to the needs of all of them. And like I said, it's a welfare state, so there's a lot of programs going on. So that dharma is thought to be upheld. And next slide, please. And if you look at thus dovetailing into the rates of income tax, if you look, there are no major changes in the tax rates and tax slabs. I was hearing the Honorable Revenue Secretary speak on this, the key proposals that they have brought out, what is the rationale, etc., etc. Some interesting anecdotes I will share with you. So someone said, you have not made any changes, you have not given any standard deduction. We were expecting so many such benefits to the middle class and etc., etc. So what he says, and being a revenue official on the revenue side, so he says, he makes one point. What he says? So he has thrown at us a lot of figures, especially for financial year 1920, assessment year 2021. What he says is that there were 6.3 crore taxpayers who filed their return, of which 75% filed income up to 5 lakh rupees. That means only 25% is above 5 lakhs. Of the 25% also, 17% were between 5 and 10 lakhs. Meaning, what he says is almost 92% of the return filing population is filing income below 10 lakh rupees. And that means only those effective 8% people are going to pay taxes, because for up to 10 lakh, some deduction here, there, etc., there may not be any need to pay tax. Another interesting anecdote he shared is that of this, salary constituted about salary, 87% are filing below 10 lakhs, and the same number for non-salary is about 96%. And last, he is saying the effective tax rate is about 22.54% for this year. Pandemic year is left out. Details will be analyzed later. This is AY 2021. Earlier, 1920 AY, it was 28%, almost 27.9. So there is a reduction in the effective tax rate, of course, because of initial pandemic effects. And also the corporate tax regime and the individual tax regime was also liberalized. So some effect of that. This year it will definitely pick up. So amidst all of this, he's asking, where is the tax base? How do I give relief? So this is the taxman's thought process. Okay. And therefore, as we get into the further discussions, more of them in the further discussions is more about our technical, our bread and butter kind of discussions. But when it comes to a macroeconomic level, not much has been tinkered. They want to give a regime of stability. I think I'm seeing this for the trend for the last few years, broad stability. Budget will now, of course, GST has already been taken out of the budget making exercise. More or less, the Honorable GST Council makes announcements on a month-on-month basis. So budget will now be only a direction giving exercise with not much shocks, perhaps. Now, in terms of the capital gain change to the surcharge, what they have done is that, of course, if the total income includes dividend and long-term capital gains, the effective surcharge could have gone up to 37% and all that. That was creating a lot of heartburn. They have made it 15%. They have capped it at 15%. Similarly, and this was also something I heard the Honorable Revenue Secretary say, that when representations were made to them, they felt, what is the difference between a cooperative society and company when it comes to taxation? Why do we need to discriminate? And therefore, giving that level playing field, they have reduced the rate of surcharge for cooperative societies, and they have brought it in line with a company. So from 12%, they have brought it to 7%, between 1 and 10 crores for a cooperative society. Similarly, minimum alternate tax for a company is around 18.5%. For the corporate, for 15%. For the cooperative society, why it should be at 18.5, and that's something they have addressed. They have brought it at parity with the company. That takes me to the next slide. So there are certain measures aimed at promoting voluntary tax compliance and reducing litigation. Reducing litigation, we'll see subsequent slides. So here is one of the big ticket item of this budget. Hitherto, if a taxpayer detected that there is an omission, or he said there is a mistake, commission, which has occurred, I want to pay more tax. I want to make a clean breast of certain transactions. I want to come clean. I want to file the return of income. Please permit me. The due date for filing revised, belated, loss, all those returns are passed. So what is the recourse? I could have gone under section 119(2), make an application to the learned CBDT, Central Board of Direct Taxes, asking them for permission, but it's a long drawn process. Not everybody may be able to access that. So if you see the past few budgets also, this one common thread is there. They want to promote voluntary compliance. In that, the off byproduct is revenue is also augmented. And that's a classic provision in front of you, updated return. What they have now said, okay, in the earlier regime, there was no other recourse. Only 148 could have done, and then that goes into, again, extension of time and litigation also needless. Therefore, this simplified process they have tried to bring in. So they say, an updated return, if somebody has detected a mistake or a commission or an omission, they can file an updated return within 2 years from the end of the relevant assessment year. And while doing that, 2-3 things are important. Can you file a loss return now? Answer definitely should be no, because loss return beyond due date cannot be filed. And so this cannot become a backdoor entry for a loss return to be filed. Similarly, can this updated return lower my tax liability, what it was earlier and what it is now? Can it be lower? No. Answer is no. Government doesn't want to make loss out of this, doesn't want to lose revenue on account of this benevolent gesture that they have come forward. Similarly, it cannot increase the amount of refund. If these conditions are taken care, you can file the return. But along with that, you have to pay the tax. The tax, as they have defined, is that in the first year, if you pay, in the first 12 months, if you pay, please pay 25% of additional tax, which is computed to be income tax plus interest payable. And in the next 12 months, second period, if somebody is paying it, filing the updated return, 50% of the additional tax, which is reflected as is discussed just now. The logic for why they have kept this additional tax at a premium is because they want to give premium to honest taxpayers. Normal taxpayer has already done his bit, paid his due contribution to the government well before, almost 2 years back. And now if you are allowing somebody to make use of this and not pay any more tax, that is not fair. And therefore, they have made this higher tax, which is to be collected, 25% and 15%. If at all a suggestion could be given, the only point I feel it's a very welcome move. If at all only one suggestion could be given, is that the 25% and 50% could be paid on additional tax, no problem, income tax. But to pay that on interest, that is little harsh. Perhaps they may consider. And also I heard the Revenue Secretary, Honorable Revenue Secretary say they are open to looking at these rates, 25% and 50%, but I have my own doubts, they may not do it. Litigation reduction, next slide please, was one of the main themes of this section. So what they have done, friends, earlier we had, earlier meaning we still have, budget is not yet discussed and approved. So section 158 and 158A. 158A and 158AA. 158A where assessee can avoid filing repetitive appeals, and 158A, revenue can avoid filing repetitive appeals, especially when the matter on a common issue of law is seized off or pending before the Honorable Apex Court, Supreme Court. Again, what they have tried to do here is that now they have expanded it to say that if supposing a CIT appeal, Honorable CIT appeal has passed an order, that is against the revenue. Revenue has to naturally, is contemplating filing an appeal before Honorable Income Tax Appellate Tribunal. They may wait. They will inquire where is either any similar issue or on any question of law is pending before Honorable High Court or Honorable Supreme Court. And if it is, then they have to inform the assessee, take him into confidence, him or her into confidence, and say, this is what we are proposing to do. We will not file an appeal right now. We want to but reserve our right. When the finality will be attained, when the Honorable Supreme Court or when the Honorable High Court has given an order, and if that is in favor of the revenue, then they will activate the learned assessing officer to file an appeal within the due date and to be calculated from the date of receipt of that order. Effectively, what they are saying, I don't want to clog the judiciary process of Honorable High Court and Honorable Supreme Court. We don't want to. Even the Honorable ITAT, we don't want to clog it now. So we will wait. So this is a provision which was already there, which has been expanded now. And therefore, 158AA goes into sunset. It will not be there now. The next one is a more like a, giving effect. Friends will recall in the last budget, continuing their theme of easy dispute resolution, the union government had brought in the concept of dispute resolution committee. Up to 10 lakh or up to 50 lakh, we can go for small taxpayers can go for early dispute resolution. A collegium will be there and they will decide and all that. But the enabler was not there. If the directions are given by the DRC, whether AO can pass the order, that was not there. Perhaps it was a slip up. Now they have rectified it. They have brought it that. This budget will be remembered perhaps for another reason. There were quite a few things that they have pushed in as being the legislative intent. There could have been many more things, I agree, but they have done a few of them, and that's in front of us. To begin with, what they have said, cess and surcharge. In the context of business income, is it allowable deduction, expenditure or not? Unfortunately for the revenue, they had issued a circular. Let me see if I can trace that circular. There was a circular. Yes, I got it. Somewhere in 1967. So we know we have section 40A 2Is, small 2Is. And that says tax is not allowable expenditure. But this circular, what they said, recently a case has come to the notice of the board where ITO has disallowed cess, which was paid by the assessee on the ground that there has been no material change in the provisions of 10.4, section 10.4 old act and 40A 2Is, 2 of the new act. This is 1967. Circular is issued in 1961. Circular is issued in 1967. Within 5-6 years, law also has not evolved, but they have issued a benevolent circular like this, and that has come to haunt them now. Because now more and more tax is being augmented through the medium of cess also. And so what the circular says continues, this view of ITO is not correct. And the logic was that when 1961 law was framed, the wording for 40A small 2 was that any sum paid on account of any cess, rate or tax levied on profits, etc., etc. But when they approved when the Honorable Parliament approved the 1961 law, cess only was dropped. That means only rate or tax was remaining. So this is, which means this seems to be the Honorable Union Legislature's intent. That intent is negatived by this intent now. In between, what happened? A lot of water has flown. Judicial precedents have emanated. We had the Rajasthan, Honorable Rajasthan High Court, Chambal Fertilizers, followed by Honorable Mumbai High Court sitting at Panji. That was Sesa Goa. They said cess should be allowed because they quoted extensively from the CBDT circular. And naturally, the government had to act. They have now clarified with retrospective effect that tax was always deemed to include cess and surcharge. So therefore, this is not an allowable expenditure. Friends, this is one of the rare cases because remember last year, much earlier, Honorable Finance Minister that time, Mr. Arun Jaitley, he had made a promise on the floor of the House, we will no longer indulge in retrospective legislation because that is now coming to haunt us, Keynes, Vodafone, etc. Now you see here, this one clause, surcharge and cess, they have now made it retrospective effect from FY45 when cess was brought in. Next, please. Another legislative intent explicitly mentioned now. Section 14A, we know, disapproves claim of any expenditure where you have exempt income. Now that have exempt income meaning whether exempt income should be earned or is it enough that I have investments capable of earning exempt income. Matters travel through the judicial process and certain courts took the view that if no exempt income has been earned during the year or it has not accrued, that is the question of disallowance under Section 14A. In fact, the learned CBDT had come up with a specific circular stating that even if no exempt income has accrued or arisen or has been received in this year, still provisions of 14A should apply. But everybody was taking the benefit of that benevolent court judgments, and that now has been clarified by in the budget to say that even if that was never the intent, even if exempt income is earned or not, we still will have disallowance under Section 14A. That is one important change they have brought in now. Next, please. Oh, yes. Section 37, again a clarificatory only. What is this clarification? The immediate trigger was on twofold. There are certain, we know that any expenditure for infraction of law in India is not allowable expenditure. Okay, so that's the one section where you will find illegality is addressed by our Income Tax Act 1961. So if an illegal act is being committed and any expenditure is incurred for that, illegal or immoral, against public policy, etc., that they are saying they will not allow. It's there in the act. But courts interpreted that to mean, okay, infraction in India. What about infraction outside India? That chalta hai. That should be permissible. So this is one set of paradigm. The other one is that, and this is quite a funny one, and I had the opportunity to argue this matter before tribunals, honorable tribunals. In the case of a doctor, Medical Council of India guidelines are applicable, like CA Institute guidelines for us. One of the guidelines is that, look, you cannot take benefits from pharma companies, to that effect. The interpretation that was presented by ingenious taxpayers is that, okay, doctors are governed by MCI guidelines, not the pharma companies. So if the pharma company is giving, what can we do? That should be allowable. And this was a real chaos, I'll tell you. Several ITATs decided it is allowed, several have said it is not allowed. And so finally, after all this, after seeing this tamasha happen for so many, actually it is for so many years now, finally I'm happy that the budget has addressed this, the government has stepped in, finally. So this is the second paradigm. So effectively what they have said in this budget is that any illegal expenditure, whether within India or outside India, we will not allow. Similarly, in respect of deductibility of expenses or hospitality expenditure incurred on doctors by medical companies, sorry, we will not allow. Very explicitly they have brought in. The third thing is that compounding of offenses, that also we will not allow. Earlier explanation, they have given 3 parts and clarified it, more abundantly clarified. Again, the legislative intent. I only have one small point here, which is, if you see the plethora of judgments or the field of judgments which have emanated on the issue of compounding of offenses, courts in India have tended to look at it in the through the prism of whether it is compensatory in nature or penal in nature. If it is compensatory in nature, like I constructed a multi-story building, and then without permission I have extended to 3 floors, I can regularize that at a later point through paying some regularization fees to the municipality. Those kind of expenditures have been allowed. Where it is a penal in nature, this compounding offense is penal in nature, courts have said we will not allow it. It is against public policy, immoral, vagera, vagera, like that. How will courts now view this? Because now compounding as such has been disapproved specifically. Let us see, time will tell what is there to be interpreted now further. Otherwise, as such, compounding offense is not allowed now. Very important amendment, this, friends. 3 parts to it. The first one is that in an amalgamation, company A will get merged into company B. 2 companies are there. A merges into B. When I make an application to honorable courts for merger, I make it from an appointed date. But the courts, honorable courts, hearing continues and I get the order much later. The effective date, which means I have completed the process, all due processes, that comes in much later. Then only company B can say that, yes, I am the successor of company A. Till that time, what happens? That's in the merger and acquisition space. This was a major heartburn, major issue, basically, practical difficulty. So 2 developments there. The first one on the first bullet point. So in between, company has to still file a return of income because it is not completely dead. It is not completely merged into and it has not ceased to exist. So it has to legally duty bound to file its return of income. So they continue to file. Naturally, a perfectly valid return, meaning a perfectly valid assessment, can also be conducted on that. And poor revenue, they were doing the assessments in bona fide. However, Honorable Supreme Court in Maruti Suzuki, they said, Are bhai, on whom are you making the assessment? You are making it on a company which is no longer there. It is after the appointed date. There is no longer that company is there. So this assessment itself is non-est. To protect the revenue's intent, they have brought in this welcome clarification, provision actually, and that clarifies many things. They have now said, look, if I complete the assessment on predecessor company, that is perfectly valid and going to be binding on the successor company. Good point they have made. Otherwise, unnecessary litigation was going on this count, which is a very fair one, by the way. The second point is that, okay, from the appointed date till the approval is received and the effective date, return of incomes have to be filed. What is the kind of return of income? Company B has become a successor or owner of all the assets and liabilities of company A, the predecessor company, effective appointed date, which could be 2 years back, 2.5, 3 years back also. But can I now file the return of income to state that this is my income? And so currently company B is able to only file its own individual return and its own individual taxable income it is offering. It cannot do that for the combined total income, including the predecessor company. So due date of return, filing return has already lapsed in between. Therefore, to address that, again, a very welcome step they have brought in. They have said, from the date of final order received from the Honorable NCLT or NCLAT or from Honorable Supreme Court, the modified tax return can be filed within 6 months, meaning there will be an enabler. The learned DG systems, they will make those provisions, one more return section will be there, and perhaps it can be done now. So within 6 months from the receipt of order approving the merger, we have to file the return. This time, successor company will file the return, including the income for the predecessor company. These are the two big ticket items as far as M&A space is concerned, business reorganization is concerned. This will ameliorate a lot of things, simplify things. One additional feature is that, friends, in the last 2-3 years, we are seeing a spate of resolutions and successful resolutions under the auspices of the insolvency and bankruptcy code. That new regime has taken off wings, and very nicely so. Typically, in any resolution, what is happening, and we are seeing that, is that the tax dues in the waterfall mechanism of satisfaction of claims, tax dues come somewhere way below. And therefore, invariably, the tax department tax dues have to be covered under a haircut, meaning the resolution applicant, the new investor who is coming in may be saying that I may not be able to pay those taxes, and therefore government has to bear that, and they do so under the IBC code. If that happens today, if the honorable finance minister or the honorable revenue secretary were to call for, show me what is the total demands which is outstanding, that will include all those companies also on which resolutions have happened, and that will give a very wrong, faulty, and a misleading picture to them for decision making. They will think that a lot of tax is to be collected, whereas under the IBC regime, a lot of them have gone under haircut. No, any learned assessing officer was saying, what can I do? I don't have any power to delete it from the DNCR register. Outstanding demand position, I cannot update it. To enable him do this, delete such, give effect to the orders passed by the Honorable LCLT, new 156A section is sought to be introduced. Friends, I was hearing the chairman, Honorable Chairman of the CBDT, and he said this is one of the major reform that they have brought in. Signal reform is what he was saying, which is to state that if you look carefully, today, it is the AO is duty bound to give effect to whom? Honorable CITA's directions, Honorable ITAT, Honorable High Court or Supreme Court, Honorable Supreme Court. This will be perhaps the first time where an outside body, namely the Honorable National Company NCLT, Law Tribunal, they will have to give an order, and that order will be binding or given effect to by the learned assessing officer under the Income Tax Act. This is one of the rare such cases, no? Perhaps the first time. Next slide, please. Certain other amendments quickly. Staying on the theme of promoting voluntary compliance and reducing litigation. Insofar as computation of tax is concerned, what they have simply stated now is that interest under section 2011A. There was a controversy as to whether it has to be from the date of date it was deductible, deductible which goes in the last month, or is it from the date of payment, which is the next month, 7th of next month, we have time. But there is this dichotomy which is always there. There are court cases which have gone either ways. So what now they have said is to kind of give some finality to this, or the legislators again intents, so to speak. This budget says whatever the TDS officer will make an order, the interest you have to pay according to that, whatever that may be. Okay, so they have sought to do that. Another change they have brought in. Again, spelling out their intent, and they have done so nicely, is that 43 under section 43B currently, any interest expenditure we can claim provided on actual payment basis. Payment has to be made. Whether it is actual payment to be made or not, there in two situations, people were taking an interpretation that there is a constructive payment of interest. What is that? When the outstanding interest, I have not yet paid it, outstanding interest is converted into a loan. Look, I have already discharged interest liability, so allow me. Similarly, they converted into a debenture. They issued debentures against that outstanding interest. Please allow me now. This thing is discharged. Constructive discharge and all, they don't want to get into. Honorable CBDT has now said actual payment means actual payment. I will not allow anything else. The next theme that we proceed to is socio-welfare measures. What are the kinds of things that they have given? Two quick things to move ahead. So under section 105 BAB, a concessional tax regime was brought in for manufacturers who have started manufacturing activity before March 31, 2023. We wanted to promote entrepreneurship. Owing to pandemic and all, there is some difficulty in starting the manufacturing operations, and that being alive to that, they have now extended it by one more year. Similarly, in respect of startups, friends, some figures for you. India is home to the fastest growing startup community. There is about 14,000 startups currently India is having. We are the third largest, and of which unicorns, where the companies are claiming valuation in excess of $1 billion US, that we have about 83 today. And of that 83, 44 had come in 2021 financial year. So startup ecosystem has to be nurtured, and therefore they have extended that by the date of incorporation for a startup, they have extended it by one more year. These are understandable developments. Certain developments in the IFSC space, friends, keen watchers of the budget would recollect that in the past few budgets, consistently a theme has been there to promote activities conducted from IFSC. They want to make IFSC more attractive. Tax is one of the medium they have chosen, and what benefits can be given. So every year there is some incremental activity going on. So this year, some few initiatives the government is taking. Last year, they had said that any royalty or interest income earned by non-residents from leasing ships, leasing aircrafts to units in IFSC, there is a tax exemption they proposed. This year, they have added ships also to that. So something like that they are making incremental. And they have also clarified that in respect of category 1 and 2 AIFs, the angel tax, section 56(2)(7)(b), that will not apply. Next. Two more relaxations. Yes. So friends, under presently under section, I think 80CCA or something, 80CCD or whatever, there is an employer contribution if the central government is making towards the National Pension Scheme, NPS, the deduction threshold is up to 14% of salary. This is only for central government employees. In respect to any other employee, it is 10%. The government, union government, has now made it possible for state governments also that they can also contribute beyond 10%. So to bring parity of state and central government employees, they have now said that 14% benefit will be extended, deduction will be extended in case of contributions to NPS, even by state governments as an employer. 80DD. 80DD, friends, you will recall, it deals with the medical treatment of handicapped dependents. So any expenditure towards them is allowed. That includes payment of insurance premium for purchase of annuity from life insurance companies. Jeevan Aadhar is one such policy offered by LIC. One of the conditions for such a policy was that the lump sum or annuity cannot be paid during the lifetime of the person who is taking the policy. The policy is typically taken in favor of the handicapped dependent, so that if anything happens after the parent or the guardian or the person who's taken the annuity, the proceeds should go to the handicapped dependent and he need not suffer, he or she need not suffer. That was the intent. But the condition was that during the lifetime of the parent or the guardian, that lump sum or annuity should not flow back, should not be payable. Now this creates one hardship, and that hardship was taken up in a public litigation right up to the Honorable Supreme Court. The Apex Court has held in that case that this is a hard provision. There could be situations where the handicapped dependent may need parts of the corpus, parts of the annuity, even during the lifetime of the parent or the guardian or the person who took that insurance policy. Why should it not be? It's after all money which is legally due back to the handicapped dependent. It is for his welfare measure. So recognizing and showing a tolerant bent of mind and being alive to this kind of a practical difficulty, this budget has made that relaxation. What they have stated is that even if annuity was flowing during the lifetime of the parent or the guardian, deduction under section 80DD will still be allowed in respect of those policies. The two conditions: the parent or guardian should have already crossed 60 years of age. Perhaps the intent is that there will not be any wrongdoing at that age and that stage, perhaps. And premium should have stopped for that. Deposit should be discontinued, meaning you can discontinue that. This is again a welcome provision. These two reliefs, we already know, friends. Last year, mid-COVID pandemic peak, the CBDT had made through the taxation amendment laws this announcement. This was there in the press information bureau's release also. That is what now they have brought into the law. Broadly what they said, any amount. So today section 17 subsection 2, which is perquisite, states any amount paid by the employer to an employee, right, that other than monetary things, that will be in the nature of perquisites. Now there, whether any medical expenditure borne by the employer for the treatment of its employee for COVID-related illnesses, whether it will be a perquisite in the normal course, it should be a perquisite, naturally. His or her expenditure, employee's expenditure is being taken care of by the employer. That is a fit case for perquisite. However, given the peculiar situation, this has been taken out from the clutches or the purview of perquisite, and it is now stated that any amount received from the employer for COVID-related treatment, COVID-related illnesses, that will not be treated as a perquisite. When I read the provision, perhaps in the memorandum of the finance bill, they have stated that even if the amount is paid by the employer for medical treatment of employee or his family, his or her family members, that should be allowed. But that his or her family members, how it would, it is not perhaps reflective in the bill, in the finance bill. But that they will clarify, but I think it is allowed. Similarly, in the unfortunate event of the demise of an employee, if the employer were to give any amount to the family members owing to the death being because of COVID-related illness, then up to any amount that was not to be treated as income in the hands of the family members under section 56 to 10, currently we have anything given above 50,000 is by way of a gift is taxable. But this is an exception they have made. They said any amount given by the employer to the next of kin on the unfortunate death of an employee under COVID circumstances is not to be treated as an income. There could also be situations where websites like Impact Guru, Crowdera, Keto, they are all doing crowdsourcing. So maybe the deceased employees' friends could come together, or this crowdsourcing and all could happen for the purpose of taking care by way of some compensation to the family of the deceased employee. There again, it will not be treated as an income, subject to the limit of 10 lakh rupees. So these two provisions were there earlier also, meaning last year they were introduced. They have now brought it into the legislation. One small point, if I were to put here, is that whether the 10 lakh rupees limit they say is that if friends collectively, persons other than an employer gave some compensation, collected compensation, gave it to the family. If it is 12 lakh rupees, whether 12 lakh rupees will be taxable or 2 lakh rupees will be taxable. In my view, perhaps it will be only 2 lakh rupees. The first 10 lakh should be not taxable. It doesn't make sense otherwise. Up to 9 lakh rupees, it is not taxable. But when it comes 11 lakh, entire 11 lakh is taxable. Perhaps it is not. Current wording is not to that effect or up to the mark. Next slide, please. Again, a provision, perhaps in keeping with certain decisions, perhaps the government of India is taking or going to take. Section 79, we all know, if the majority of the shareholding is transferred between the date the loss was incurred and the assessment date, and then to the extent of more than 51%, such loss will not be allowed to be carried forward because we suspect loss was the sole interest, something like that. So that anti-abuse provision is already there. What they have now stated is that, look, if any disinvestment we are going to make in public sector companies, again, this is perhaps the contribution of the DIPAM ministry to the union budget. What they are saying, if public sector companies we are going to disinvest, when that happens and if the shareholding results in a change of more than 51%, please don't make it taxable. Only you please see what is the ultimate parent company. If that is still the central government, ultimate holding company, that remains the same parent, suffice. And in the year in which that condition is violated, from that year onwards, we'll make it taxable. This is more for PSUs, disinvestment, which government is perhaps wanting to expedite in the coming months and year. We now turn to the next section of our theme, widening and deepening of the tax base. Friends will recall, we already had section 206AA, which said that if you don't give me PAN, higher rate of TDS will follow. In the last budget, the two new sections were brought in for TDS and TCS, which stated that if the deductee did not file tax return for last 2 years, penalty will be there. What kind of penalty? 5% TDS or higher of whatever is the applicable rates under treaty or under act, twice the same, etc. And so they sought to penalize that. That now, and there is a utility which has been provided. They have enabled that. You can check last 2 years, has this payee or deductee filed the income tax return? He has not done, so we will go for implementing 206, the AB section, higher rate of TDS. What they have said is that perhaps it could be a little harsh. They have liberalized it to 1 year. The check we have to make now for not 2 previous assessment years, immediately preceding the year in which deduction is being made. We now need to check only 1 assessment year immediately preceding the year in which deduction is being made. Now, being a follower of the union budget for so long, I myself am little surprised how can these kind of errors creep in. Friends, even in our kind of day-to-day, the way we manage our affairs in our respective offices or workplace, there is a maker-checker concept and all that. This kind of error perhaps was not expected. What has happened here is that in 206 AB section, okay, the tax shall be deducted at the higher rates in case you didn't file, the deductee didn't file return for last 2 years. There, they have made a goof up, which is where tax is required to be deducted at source under this section, or on any sum or amount which is credited, paid or payable or credited by a person, that has to be hereinafter to be referred to as a deductor, because only deductor can make the payment or the claim. He is only duty bound to do TDS. No. But they said it is deductee. How come these kind of small errors come, and that too at the Government of India level? It's little surprising. Now they have rectified that, deductor. Yes. So you're all aware, section 194 IA, which mandates recovery of TDS at the rate of 1% when the sale consideration in a property transaction, immovable property transaction, exceeds 50 lakh of rupees. When doing that 50 lakh of rupees, we are looking at only the sale consideration, because that's what is provided at the moment. They have now harmonized that, because in 2 other sections there is a different regime. Why should we leave out small crumbs of revenue? So what they have stated that if the sale consideration, you need not do some planning. We already have enough anti-abuse measures, which is there is a stamp duty value which can be checked. Whichever is higher, that now we will substitute. So the payment of TDS, the application of TDS under section 195 IA will now have to happen on a comparison between the sale consideration amount and the stamp duty valuation. Now, while that is being done, one question I have is that what about the tolerance range? Because in those two provisions, that is section 43 CA and 50C of the Act, within the confines of computing income from PGBP, profits and gains of business or profession, they have given a plus minus 5%, now 10%. Tolerance range is there. They have not given tolerance range here. Perhaps you can watch out for the budget speech, union budget analysis like this in the next or next to next year. They may introduce that also. We don't know. Currently, it is not there. Next slide, please. That's right. Business perquisites. Friends, often we have situations where in the course of our routine business people are incentivizing their agents for more sales, etc. So for a business, sales is the main engine from which income comes. So high targets are set, especially in marketing space. And if targets are achieved, well, the agents or whoever have achieved this, helped us achieve this target, we will reward you with mobile phone. We will take you to Singapore. We will give you some benefits, etc. No doubt, we already have section 28 small 4 in the Income Tax Act, which says that any perquisite, any benefit or any perquisite, whether convertible into money or not, based on some valuation, that arising in the course of business or profession, that should be taxable in the hands of the recipient. Taxable it is, no doubt. That agent also has to show this in his income tax return. Na? Why will he show? What is his incentive to show? And so the government felt they don't have a channel or a means to detect such unreported income. Therefore, they have brought in this TDS. So they are obviously, they have fastened that responsibility on the person who's providing that perquisite. So the businessman who is seeking to incentivize his agency channel, he or she needs to now do TDS whenever they are giving such benefits to the agents or the sales people, etc., etc. And for that, 194R section has been brought in at the rate of 10% of the value of such perquisite or benefit. If it is in kind, it has to be valued. And if it is, and in both cases, even if it is partly in cash and partly in kind, TDS has to be done before giving such benefit. If it is wholly in kind, perhaps they have to recover it from the person who is recipient. And if the employer decides, if the businessman decides we will bear it, in which case he has to do a gross up now. He or she has to do a gross up. But TDS has come in for such payments. It will be, this section is a little tricky now. How will we go through? Perhaps we will have to go through our expenditure statement, whatever our expenditure ledger account heads we have, what are the kinds of sales promotion we have done, and then we have to be aware or provide guidance to our assessees or our clients or in companies or wherever you are there, to implement 194R TDS mechanism. Basic threshold limit is 20,000, but in 20,000, what we get these days? And smaller businessmen, individuals or HUF who are not having more than 1 crore business income or 50 lakh professional income in the immediate previous financial year, they need not do this 194R because we want them to grow, perhaps. Next slide, please. Insofar as filmmakers are concerned, after completion of each film, they have to file a return under Rule 121, Form 52A. Broadly, what that means, in completing this film, what were my expenditures above rupees 50,000, whether in cash or in check? What was that? I have to give a list, PAN number, what was it for, to whom, employee or otherwise, etc., etc. Simple form. That used to be given. Now what they have said is that, look, so many proliferation has happened. OTT platforms have come, and pre-launch, post-launch, so much events, so much expenditure is happening. As we saw in RRR movie recently, lot of money was spent on pre-launch, etc., etc. Anything above 50,000, now they want specified activity is what they have brought in, and they have defined event management, documentary production, production of OTP, etc., etc. Sports event management also they have brought in. So expanding the ambit of, so widening and deepening tax base, no, they have done it. Next slide, please. We already have under section 94 or something, we already have bonus stripping and dividend stripping anti-abuse measures now. Simply put, when a person is buying shares, for example, and within 3 months bonus shares are issued, he now has more shares. And whenever a bonus share is issued, economic theory is that later on, because there is more supply of shares in the market, share price will come down. But I had brought the original shares at a higher price. So there was a tendency to book loss. So I could sell few of the shares, could be from the bonus shares, what I got. I could sell that within 9 months of the record date, and I could book some loss, set it off against any other profitable income, and I had a win-win position. I got the set off of loss also, and my original intact, my original portfolio is intact or perhaps accreted. So bonus stripping, in that cases, what was happening is that because of the bonus stripping provisions, that loss, whatever is being offset against profitable income, that will not be treated as a loss, that will be denied, because your intent was not, it was mala fide. And so that loss will be taken as the cost of acquisition of those bonus shares. That's the existing provision. What they have now sought to do is that this, in certain contexts, it was applicable only to units. They have now made it applicable to securities. And securities, friends, we know include shares and and stocks. So all that now they have covered. And similarly, we have so many new ventures, alternative investment platforms coming up, like InvITs, REITs, AIFs, etc., etc. So for them also, this anti-abuse measure they have brought in. Next slide, please. We now turn to another highlight measure of this budget in the theme of revenue mobilization. Something which at the beginning of this session, friends, we had the opportunity to hear more about what is a VDA, virtual digital asset, and all that. So friends, a new scheme has been proposed to cover virtual digital assets, and any transfer happening from that now will become taxable specifically. I heard a lot of discussion about illegality, legality, etc., etc. Interestingly, when I heard the Honorable Chairman of the CBDT, he made a very interesting point behind the introduction of this VDA, taxation of VDA. What he said, look, the discussion about legality, illegality is still going on, but it has already caught the fancy of Indian investor. It is gaining some kind of momentum, craze, popularity. So the government of India has given us, he is talking about the revenue, income tax department. It is a honor for us, he said, that the government of India has fastened the responsibility to gauge what is the depth of the market before taking a call on that legality, illegality, which discussion I heard at the beginning of this program. And a lot of discussion is already happening outside. The mechanism of taxation by making VDS taxable under the Income Tax Act 1961, government is now gauging the sense of the market. What they have done, how big it is, these are his words, to lay a roadmap for the eventual legalization or otherwise of the virtual digital asset or cryptocurrencies, as simply put. How big it is, who are the investors? Government wants data. What is the easiest mode? Very intelligent thinking. They have said, we'll not wait for Honorable Parliament to discuss. In fact, a lot of expectation was there. It will be there in the winter session, and now perhaps in the budget session, they will take up that bill for whether it is accepted or legalized or not and all that. But that didn't happen. Income tax department will now supply the information to the policymakers, because now TDS mechanism has come in. That's a new development. Under section 194S, something they have proposed. So simply put, what is this regulations that they have brought in? They say any transfer of virtual digital asset, and they have defined it very broadly, NFTs, cryptocurrencies, and anything like that. It's a technical definition they have given. We all will also have to now scratch our brains. Any new kind of innovative products brought to us or our attention by assessees or taxpayer or clients, we will need to figure whether it fits in the definition. But a very, very high level technical definition, where they have stated that those will be qualifying as virtual digital asset that is now introduced as a property under the definition of property for the purposes of section 56 to 10. And what they have simply stated is that any transfer of such VDAs will be, we want to tax it at a flat rate of 30%. We will not allow any deduction whatsoever except for cost of acquisition. So I bought a VDA or a cryptocurrency for 1 lakh, 2 lakh rupees, as we saw at the beginning of the program, one Bitcoin. And now if I'm selling that one Bitcoin for 5 lakh minus 2 lakh, whatever my cost was, 3 lakh rupees, 30%, I have to pay flat tax. And this is now going to be under income from other sources. It is not under capital gain. Because if it were the case, then it should have been carved into the definition of capital asset. That doesn't seem to have happened. And now, therefore, I am tempted to venture that this will be classified under income from other sources. Whether I can gift such VDA, again, you can, but you have to pay tax if the amount is exceeding 50,000. Because now, for the purpose of 56 to 10, like I said earlier, VDA will also be treated as a property. And how will government track all this? Through TDS mechanism 194S. 1% from the payment to a resident on transfer of VDA, that will now need to be deducted, and that has to be paid to the government and reported also. So through all these mechanisms, perhaps government will then finally take a call. Some basic exemption is given, basic concession is given for certain people, but that's there in the fine print. Next slide, please. That's about the VDA, much touted or much discussed separate regime they have brought in, and so on and so forth. So revenue mobilization, what they have done earlier, we had, if an Indian company receives dividend from its foreign affiliate, not a subsidiary, affiliate, because the nominal value of equity shares is more than 26%. Indian company is holding in that foreign company. And if that foreign company gave dividends, it was taxed as a concessional regime of 15%. Perhaps the logic was that we needed more foreign exchange. We have to bring in that money. 15% we were to tax. Last year, they abolished dividend taxation, etc., etc. And therefore, now what is happening? When the similar Indian domestic company, if it is paying dividend to the Indian investing domestic company, that is taxed under 30%. Why should this be under 15%? To bring that parity, again, 15% more they will earn out of all this, something like that. That's the amendment that they have sought to bring here. So concessional regime for such dividends is gone. Another one, more like an academic theme, phasing out of exemptions. By now, friends, people who have been watching budget for last so many years, especially the last 10 odd years, will vouch that most of the exemptions have been phased out. A lot of sunsets have come, and few still sections are surviving. They have to see the sunset as it is happening. And this is the latest casualty. These are what? Section 8, 8A and 8B. Friends, there were times when India needed to bring in foreign experts under, for various programs that they were implementing. And when these foreigners or expatriates came to work here, they should not be taxed. Who are they? When Indian government has entered into an agreement with the foreign government, Section 8. Similarly, Indian government has entered into an agreement with, let's say, a World Bank or some foreign multilateral institutions. Again, those experts are not coming out of choice. They are coming at our request. Therefore, we made exemption for whatever incomes they were earning from work in India. And India sourced income only we wanted to tax. So whatever they were getting abroad, those and all were exempt. Similar exemption we now extended to their family members also, because they will come with their families. Otherwise, we will become a hardship posting. It will not be an attractive place. And if we don't get those expatriates, the talent we will not be able to draw upon. That expertise we will not get. So we gave this conceptual or exemption regime for such remuneration of those people. Those and all, anyway, they have outlived their utility. And also, we have made a lot of rapid advancements. We now, if at all I am taxing them, let me give them credit in their resident state, no? If I have taxed them in the source state, resident state can always give tax credit, we can always get, no? So, etc., have advanced. Therefore, these exemptions have been phased out. More academic. Rarely anybody will be currently under this. That brings me to some big ticket announcements which have made in the budget. 2 more big ticket announcements have been made that I am seeking to cover under rationalization theme. Okay, that is about trust, charitable trust, and that is about assessment and reassessment proceedings. Quietly, they have made a lot of tinkering. This section 248. Friends, what was happening? When a deductor deducted TDS from any payment they were to make or they have made to a non-resident, and ultimately that contract itself got cancelled, there was no provision for refund. This poor chap has already paid the TDS. He cannot claim refund. How will he claim? The only recourse was appeal under section 248, because government perhaps was very cautious those days to think, let me evaluate on a case-to-case basis and then I will give you the refund. Now they have sought to liberalize that. Please go to the TDS officer only and you please take the, because in other cases we can do, why not in this case, something like that. So you make your application to TDS officer and he will process it. So that's the relaxation they have brought. And if the learned TDS assessing officer is not giving you the refund, he makes a contrary order, that is now made appealable, section 246A. And therefore, section 248 is given a burial, sunset, over. Next, please. That's right. Cash credits. Friends, student, what is the regime? Under section 68, if any amount is found credited to our books of account, and if we are not able to explain, that's treated, the source, that is treated as cash credit, and that is to be taxed under special regime. Typically, what you used to do in assessments, we will prove the bona fide and the identity of that payment and the person who provided that credit. Now what they have stated is that you please explain in your proceedings what was the source of the source who provided you that credit. Where did that guy who gave you the credit in terms of amount or in terms of credit entry, where did he get it from? His source you have to know, his or her source you have to know, explain. Okay. Source of source need not be explained in the earlier regime, and judicial precedents, etc. were there. Now that and all has been nullified. They have said this is actually a means of tightening the screws. So similarly, what they have done, if they have made this amendment also, if there is a loan or a borrowing, that is again a credit. There again, you have to explain this as the source of source. You have to explain the source of funds in the hand of the creditor. Interestingly, most of the time, where will we borrow from? Either bank, nationalized bank, private bank. If I ask them what is your source, where will they give from? It will be legitimate only, we have to assume. So, but that is funny, but that is the truth. I think why they have brought this loan or borrowing, etc., is to keep control over dubious NBFCs, because many a time loans can be taken from NBFCs also, and who knows what is the source. That now you find out and you have to give me explanation. That's the message taxman is giving us under the amendment to section 68, cash credits. For well-regulated entities, they have said it is not applicable, this source of source explanation. Who is to now sit in the judgment of well-regulated? Perhaps it is a funny word they have used, well-regulated. Well-regulated as in what? Even well-regulated companies have fallen. So anyway, but be that as it may, they have said it is this SEBI registered companies, they are having some oversight mechanism. Therefore, it should be, you need not, we take that loans to be kosher. That's what is the message. Yes, friends, that brings me to, one of the highlights of this budget. In faceless scheme, they have made some revamp that merits discussion. We got sufficient time. We are on course. Another 10 and 12 slides to go. And I think we are midway. We are almost cruising properly. You see, currently faceless scheme was announced last August and September, and it is running, just gaining ground now. Now, that scheme is so far not extended to transfer pricing proceedings or DRP proceedings or honorable ITAT proceedings also still are functioning without the faceless regime. But the intent is there. Somewhere in future, we want to bring faceless regime of proceedings for these things. For that, there were sunset clauses they had provided earlier, but then they didn't know that time 2 years back when they brought perhaps and all that COVID will play havoc. So they now need to keep that flame alive, enablement alive. So they have extended it up to March 31, 2024. Honorable CBDT can come up with schemes. They will come up. So the intent is clear. Even honorable ITAT proceedings will become faceless. The main substantive provisions, next slide please, is what I have here, and for which I will turn to some notes that I have here. In the faceless mechanism, just a minute. Some comparison had been attempted. That will be useful. Friends, hitherto under the faceless assessment, by the way, what is this faceless mechanism? Very broadly, how they have put it across is that they have now constituted an NAFAC, National Faceless Assessment Center. Many of us have now faced that. Yeah. And under that, they have created various units. So the assessment unit is the fulcrum who will conduct the assessment. When they issue notice under section 143(2) or 142(1), they will issue. And then through the NFAC, it will come. Everything is now interfacing through the NFAC, NAFAC. And the assessee will get the notice. He or she will have to respond to that notice again through an NAFAC. The assessment unit will look into it. They will feel, oh, certain things need verification. Hitherto also this process was there. Now I am telling you certain clarities they have given. What they have said, verification unit, what you will do, because they are also growing wiser by experience. It's now almost 6-7 months they have come into that regime. They have now made more explicit. As things move forward, perhaps in the next budget, we'll see more tweaking and more streamlining. And the process will go on. So what they said, once I have got the information, assessment unit has to decide, oh, for this, I need someone to verify. Please issue summons, check the creditors, 133, 131, issue summons and all that, find out, make inquiries, etc. For that, I have a separate unit. I cannot do that. I am AU. I will request again through NAFAC to the verification unit. Please check and come back. So they will in turn issue the notices for creditors and confirmations and all that. They have some activities to do that. They will come through the NAFAC to us, again, assessment unit. Similarly, I have one more expert body advising me when I am conducting the assessment. I am assessment unit. This body is called technical unit. What they will do? Things like determination of arm's length price, whether treaty benefit should be given here or not, whether this is allowable or not. I have some doubt. Can you please guide me, etc., etc. For that, I have to go again through NAFAC to TU, technical unit. They will again give their inputs. So there are several people who are feeding into me. And finally, what I am supposed to do? If I am going to make a variation in the returned income, I have to first now, earlier I had to prepare a draft assessment order. They have said, don't hurry. Now they have brought in that one new concept, and that's called income or loss determination proposal, ILDP. They say, at this stage, please work out. Compute, more like a calculation. You give me what is your proposal. It will go to the NAFAC. And from the NAFAC, it may go to the, okay, what NAFAC will do is that NAFAC will issue it to the assessee. Assessee will have to provide inputs. Earlier, the provision stated that within 15 days you have to reply. That was the mandate. They have now relaxed that because it was becoming too much. 15 days within suitable time, within the time provided. That's what they have made amendment in this budget. Revised scheme they have placed on the table. And now the ILDP, the proposal is on the assessee's side. Okay, he doesn't agree, he has to reply through to the NFAC, and that will again go back to the assessment unit. It will come to me. I'll go through. I may agree, I may not agree. Whatever I do, again, I will finalize the ILDP, send it to the NAFAC. NAFAC will, at this stage itself, they can approve. Okay, I accept what you are saying. Please proceed to the next step. But at that stage, they can do one more thing. They can go to another body sitting, that's called review unit, RU. What is the function of that? Whether this ILDP is proper or not. Somebody is checking that. So multiple minds are now behind one assessment. many of us practitioners will recall the good old days when somebody is called us for assessment, just a single point, carry the documents, carry the explanations, go and meet one officer, sit across the table, explain, end of matter, order is passed. Now, so much is happening behind the scenes, and all of this is faceless. So review unit will go through your ILDP and they will say certain changes are required, boss, this is not correct, or they say, okay, we are okay. Again, they will go back to NFA, NAFAC. NAFAC will go back to assessment unit. These are the changes. Please make the changes. Or what do you feel about it? Let us know. Meaning two people are make a checker concept. They have, then we have to again write to NAFAC. Sir, we agree or we don't agree with the review unit, certain changes, vagera, vagera. So NAFAC will then get convinced and they will authorize me to issue the final ILDP. All this they have to do within the ambitious time frame of 9 months. Now they have taken 9 months, no, for time barring assessments. All that they have to do within 9 months. God help all of us. Now, the final ILDP will go and that will form the basis. On that basis, assessment unit will now have to make a draft assessment or draft order. Earlier, only one stage, draft order, proceed. Now, one stage in between, that's called ILDP, the income or loss determination proposal. Matter now goes to draft order. I have prepared. I have to give it to the NAFAC. NAFAC will issue it to the assessee. Again, second time assessee is getting this paper. He will see, and then he or she will have to now respond. If they choose to go through the DRP process, especially in transfer pricing cases, then it stops there. The DRP process goes through, and when the directions are received, then NAFAC will get a copy of the order. They will forward it to the assessing unit, assessment unit like me, and then I have to give effect to the order. I have to pass final assessment order. In cases where it is not a specified assessee, meaning non-transfer pricing cases, there, again, assessee will dispute. No, I don't agree to your draft order. Again, this thing will be given, explanation or counter or objections will be filed through the NAFAC. It will come to me as the assessment unit. I will then have to decide on that and pass a final order, which I will give it to NAFAC. NAFAC will issue, along with proceedings of penalty proceedings and all that, notices and all that will come. So this is the long and short procedure that they have brought in now. Small changes they have done. So now, as you see, friends, the key changes they have made is that earlier under faceless 147 reassessment proceedings were not covered. Now they have brought it. Like I said, 15 days window was given earlier. That was the mandate. Now they say any time prescribed. It was becoming too much within that 15 days. So now matters, like I said, for which reference will be made to the verification unit, VU or the TU, those and all have now become more amplified, specified. The ILDP is a new formation, income or loss determination proposal. We spoke about that. Key highlights I am going through and I'm telling you whether I have covered everything or not. Yes, this ILDP was not there. No such provision for that was there before. And even before assess a draft order, there was no way assessing the assessee will come to know. Now he comes to know, he or she will come to know much before. That's called ILDP. So one stage in between. So 2 times assessee will have a choice to respond. Yes, small thing. Earlier, what they were saying is that one assessment, unit work will be reviewed by another assessment unit. They have said, no, I have a now review unit, so that will take care of it. And last but not least, most important is in front of us in the center. Personal hearing allowed to the assessee that earlier, this, if I request a personal hearing, I want to explain it in person during the assessment proceedings, it was left to the discretion of the commissioner to grant such a hearing. Again, that time also it was through video conference mode only. Now they have said that if I request, meaning you have to, you have to be given an option, opportunity of being heard. Again, this will happen through video conferencing mode. The last important thing insofar as faceless is concerned is in the next slide. Perhaps, Ronnie, please. What they said was that, again, it was a very ambitious development or move from the revenue or the income tax department during the last budget, during the when they introduced the faceless scheme. What they said, assessment proceedings, if we are not following any of this procedure, look, we are wanting to lead by example. We have taken up some proposals. This is how it will run. The process will run like this. If any procedural lapse is there, if we end up violating any of this, no problem, our assessment proceedings will be void. We are ready to take that risk. Like that they said, because perhaps they wanted to lead by example and they wanted to prove a point that these proceedings are here to stay. Then they found it is a very hot potato, too much to handle. So they have now, because a lot of assessees were going to court, the process was not followed. You are still passing order under the old mechanism. You are doing a hodgepodge. You are not following the new procedure completely to the T, etc. So they have now said that section itself they have dropped, which means this kind of a bold statement from Income Tax Department is no longer there in the Act. And so violations, minor procedural violations, they will not come in or militate against the validity of assessment proceedings. Next slide, please. Reassessment. So, friends, we will recall in the last budget, the process of reassessment had undergone a revamp. Yes. So, what was the earlier procedure? If the learned AO had reasons to believe that some income has escaped assessment, he used to issue a notice under section 148 after taking permission, and assessees will file a return, and based on that return it will be taken up for assessment. This was the simple straightforward procedure. But disputes were noted about the reason to believe. It's not a proper reason to believe, etc. So therefore, what the policy framers did, let us cut this process of reassessment into two: reason to believe and that litigation portion, that let us tackle at the beginning itself, and so the rest of it will be more procedural, more smooth, and it will have less litigations then. That was their thought process. So what they said was, earlier, the last year, two-staged process. In the first stage, before the learned assessing officer could issue notice under 148 to the taxpayer, he or she will have to make inquiries beforehand and provide opportunity to the taxpayer. Yeah, after taking due approval from the principal commissioner or something like that. Principal commissioner, if it were 3 years or less, and principal chief commissioner in other cases. So they had to take that kind of a step. And this issue of notice was basically to enable the learned assessing officer to frame an opinion. This is a new new requirement they inserted last year. After considering the taxpayer's reply, the learned AO will then decide by passing an order whether it is fit case for reassessment or not. So stage anterior and stage posterior, something like that. Then notice under 148 will be issued. Again at this stage, there is a permission required from the prescribed principal chief commissioner, that they have now said, boss, you have taken once one permission. Again and again and again, you don't need to come to us for permission. Once, if you have taken under the first stage, 148A, that Chota assessment, forming the reasons to believe, at that stage only, under D clause, subclause there, if you have taken an approval, for the second and subsequent times, you don't need to come to us. That's what they have relaxed. And then another thing they have done now is that last year, if you see the section 148, had two important points. One, it said that it can be, what is the information? It can be any information that they have in their system, tax department, which is flagged according to some risk-based mechanism. That flag has no purpose, no flag, vagera, vagera. Everything is flag only now. So that flag they have deleted, and they have said, they have dropped that unwanted word. Okay. The second one is more important for all of us. If there is a final, final report of the learned Comptroller and Auditor General of India, CAG, and based on that, that is also an information that is giving me reason to believe. Okay. Now, what this budget may they have done is that if it is a learned CAG's report, that is very narrowing the scope of my reassessment, that they have dropped that reference. They said any audit objection. Friends, the problem with that is that, of course, by now you would realize where I am coming from. Audit objection meaning even that daily, regularly somebody is calling, so audit objection I have, please come and attend. That also will now become a reason to believe. And so I expect some kind of elongated or harassing tendencies. I will reassess you otherwise. Something like that may happen. Perhaps policy framers will attend to it, or they may have already given a thought. But right now, if it is going this way, there is bound to be some kind of friction between the taxpayer and the department. The last important change they have made in reassessment, the substantive one, is here. Last bullet. See, last year when they brought this new regime of reassessment proceedings under section 148A and all they brought, they said that they up to 3 years for 50 lakh or below. Above that, it will be 10 years. Income escaping assessment, 10 years tak we can go. Something like that they said. But that in respect of income escaping assessment, and which is represented by way of an asset. That was easy. Now they have made it very stringent. It is dangerous for the taxpayers. What they have stated, that represented by asset meaning 2 years back, 4 years back, some marriage happened. There was extravagant expenditure, right? Even now, there is a provision where they can ask us to file, taxpayers to file details. Look, there is this extravagant event or something you have done, and their expenditure and all, show me the source and all that. They have currently also that provision is there. But under the context of income from income escaping assessment, there they have now stated that expenditure in respect of a transaction or in related to an event or occasion, that also can be a representation. Not really necessary. There should be a physical asset that you have invested out of those proceeds, income escaping assessments. No, out of that income, even if you spent something in the past, that is also good enough for me. I can reassess. Or on the basis of any entry, well, this is very straightforward. Under search and all, this is what happens, no? The entry in the books of account, which is not reflected in the report, income being reported. So these are the changes they have made in the assessment proceedings, friends. I now turn to 2-3 more slides before I plunge into trust, and I would have just the time for that. This is again, we have been votary of this. This is the correct view actually. What they have stated, when search and seizure proceedings happen, undisclosed income comes forward. Now, what despite there being a separate rate of taxation, what the taxpayer will then contend, sir, this is business income. And so, if it is business income, any unabsorbed depreciation or brought forward losses, that should be allowed, no? I will set off, and then he will not pay any tax. That is struck down. That is never the intent. If somebody has undisclosed income, he or she better pay tax due under that regime. So they have specifically made clear that loss or set-off is there in that section where separate regime is there, but here they have now brought in explicitly to negate any court case or any court judgment or any interpretation taxpayers were taking to set off and do some planning of any brought forward loss or unabsorbed depreciation against income detected during the search, undisclosed income. Next slide, please. Some few penalty, again, not much tinkering has happened. Stability they want to show. Few penalty sections they have rationalized. It is a rationalization theme only, na? They have rationalized. What they have said, penalty on undisclosed income and penalty on somebody giving false statements and those things and all. Currently, learned assessing officer only has the power to levy penalty. What they have said is that Honorable CIT appeal, Commissioner of Income Tax Appeals also, who has powers coterminous with the learned assessing officer insofar as other provisions of penalty is concerned. So let these three also, why they are left out? They also, in those cases also, Honorable CIT appeal, he can levy, he can initiate penalty. That is the one change they brought. And in 272A section, what they have said is that this is a penalty where someone is asked to furnish information, and if he or she doesn't do it, penalty at the rate of 100 rupees per day of default is provided. There was a learned CAG report which said that perhaps 100 rupees is too less or it is not acting as a deterrent. So they have upped that number to 500 rupees. Before I turn to trust, some few other proposals I want to cover. Under section 179, you are aware, if a company is having tax outstandings, arrears, and if it is not able to pay, the learned AO or the TRO can proceed against the directors. But the heading of that section is liability of directors of private company, in liquidation. They have not changed that. They said, no, in liquidation or otherwise also we can proceed. By the way, we are all proceeding under that, 179. This is a technicality. And again, a major slip if you are considering the robustness of the maker-checker concept in law making. Because this should have been done long back. In liquidation, it's not only in liquidation, even otherwise they can. Also, another clarification, tax due under 179. Somebody was saying, no, fees I will not take as tax due. The intent is fees also is covered, and that also can be recovered from the director. That is the import. Small clarification, they have expanded whether the Honorable Commissioner of Income Tax, CIT, can he revise the orders passed by the transfer pricing officer, learned transfer pricing officer? It was ambiguous. Now they have made it clear to say, yes, you can. They can do it. Another thing, under section 119 of the Act, the learned CBDT has been given powers to give certain relaxation for so many things, like late filing, if you want to file now, etc., etc. They have been given so many powers to ameliorate or the hardship of the taxpayer. One such thing is that 234F is there. What is section 234F? If somebody is not filing the due date, return of income within the due date, 5,000 rupees penalty is there under section 234F. Whether that can be relaxed or not, answer was no. Now they have brought it in because they found in, and they have given the example of army men. It should be why army men, even in any other case, they should have that power. They have now done so. They have given that benefit. Power to the CBDT. Next, section 133A again a clarification. In the last budget, they made some amendment to say that income tax authority who can enter and search premises, they were to be joint commissioner and below, to be authorized by the joint commissioner. They have said that no, it is principal DG or CIT, principal CIT or principal CCIT or principal CIT. They have just expanded that. Last budget, again, you guys will, friends, you will recall, goodwill was deemed to be an asset which will not carry depreciation. The logic was that how can there be a depreciation? Whenever you are doing business, the understanding it's always growing up, so goodwill has to go up, something like that. So they said we will not allow depreciation. If that is the case, then that is supposed to be reduced from the blocks. Okay, it is goodwill is not to be considered as a depreciable asset, meaning it has to be taken out of the block. And when only goodwill remains as a block of intangible asset, then short-term capital gain should come because the block is ceasing to exist. They have now said that reduction of goodwill from the block of assets shall be deemed to be transfer. Giving effect to last year's provision only, something got left out, they have covered now. Again, another clarification, slump sale, the definition under section 242C, it stated that, slump sale, what is slump sale? Where we are selling an undertaking without assigning values to assets or separately considering liabilities. Wholesome basis undertaking is taken on a lump sum basis. That's lump sale on a lump sum basis. That sale, there were differences of interpretation. Slump sale, slump exchange. I have written articles on this actually. So if you see, slump exchange is not taxable. Slump sale is taxable. Bharat Bijli's judgment and etc. were there. So now they have said that they have clarified just that in the definition of slump sale, inadvertently sale only is still there. It should be transfer. Friends, that brings me to to me, I thought this was one of the big ticket developments of this budget. One of the very important proposal, quietly they have done, not much fanfare or not much noise around it. These days, if you see the trend of the Honorable Finance Minister, it is noted that wherever it is giving benefit to the taxpayer, only those some key highlights they are speaking in the budget speech. But otherwise, the fine print takes care of many things. Last year's budget was a key example. And friends, at this stage, I may also have to compliment the budget makers, because in this year's memorandum, friends, 2-3 years back and all, if you see the memorandum explaining the finance bill provisions, you will see it is a cut paste of the same finance bill. Nothing much can be interpreted. At one point, I used to say, why you are even giving that? It is a cut paste. We will see one document only. The memorandum was supposed to clarify what is the legislative intent. It was an aid to interpretation. But the trend was, it was being a cut paste job. Friends, this time's memorandum, if you see, of course, somebody commented it is like voluminous, 300 pages and all that this time, whatever. But beautiful job they have done. In fact, perhaps some chartered accountant only, I presume, is capable of that, and somebody has done a fantastic job explaining why cess is not, rationale behind why cess is not treated as an allowable expenditure, why 80DD changes they have made, so on and so forth. Many other things they have beautifully, more like an opinion, what we professionals are supposed to give, something like that they have done in the memorandum to the finance bill. So kudos to them, hats off to them. I now turn to this one, which is very important landmark change they have made, which is currently, friends, there are 2 regimes for charitable trusts. Either you go under section 11, 12, 13, which means we receive income and then we will apply to the extent of 85%, and balance 15 I can accumulate if I file form 10 within the due date of filing return of income. provided section 13 may, I have to take care that I do not contravene the conditionalities of my registration. Under section 12, I am given registration 12, 12A, 12AB, 12AC now. I am given registration. So I have to meet that. Also, I should not be giving any benefit, unreasonable benefit to the trustees or people specified under section 13(3), which are related parties, trustees, settlor, etc., their manager, vagara. Similarly, the second regime was under section 1023C, where incomes of certain funds, 1023C is a long section. We are concerned with only 4 subsections in between. And what was the import? Any, these were incomes of, this is an exemption provision, section 10. So incomes are exempt in respect of some approved, and they all have to be approved by the learned CBDT, approved university, approved associations, approved universities, approved hospitals, and so on, something like that. Again, the intent was benevolence, charitable purpose. Friends, for whatever reason, these two regimes have coexisted. But in that coexistence, there were disparities. So often, we practitioners had the occasion to evaluate whether a particular regime will be suitable in the present facts, which were before us for opinion or for implementation or for advice. There were several disparities. Both the regimes were not uniform. Some change somewhere, meaning something happened here, and there was always an imbalance. That imbalance is now, perhaps they realize it has reached crescendo, so now they have made both same, even playing field for both the regimes. There is nothing much to choose from now between 1023C and section 11, 12, 13 regime. So those things they have now done in this budget, and they have, that is one key highlight. The other major highlight, I realize I am at 7:55, so therefore organizers, I may extend it by 5 to 10 minutes maximum. Now, so these two regimes are there. Perhaps they have realized it is outliving their tolerance capacity. Perhaps now it has time where they should delete one and they should merge everything into one, but that's all for the lawmakers. But what they have now done, earlier, audit is compulsory if you exceed threshold, trust, 1023C or 11, 12, 13. In both the regimes, now they have said mandatory, maintenance of books is also now mandatory, plus audit is mandatory. So they have done that. This was for both the regimes. There is a punitive penalty they have now brought in for if any part of income is being applied to the benefit of people specified under section 13, subsection 3, the related parties. What is the penalty? Entire income so applied for the first offense. If it is a repeat offense, 2 times whatever income you are so applying. Meaning any payment being made to a trustee, that if it is unreasonable, again, I will come to the controversy, but if it is unreasonable, because currently also under section 13 subsection, they are allowing reasonable salary or any commission or things to the people specified under 13(3). But here they are saying, if anything unreasonable is given to those specified people, 13(3), as I am defining them as specified people, then first time if the offense is there, that part of income will be the penalty. That amount equivalent will have to be paid as a penalty. New section they have brought in. If it is second time you are doing that later years, it will be twice that number. Okay, specifically they have brought in. So they are tightening the screws behind trust. Friends, also in the regime, at a very macro plane, if you see what is going on in the world of NPOs, not-for-profit organizations or NGOs or charitable trusts. If you view what is the governmental thinking, they are going hammer and tongs behind such charitable trust with only the intent that they behave themselves, they stay within the course of law. That is their correct and noble intention. But they are going hammer and tongs. They are now keeping trusts under watch. You have seen that in the context of Foreign Contribution Regulation Act, FCRA, 1976. Similarly, you are seeing that in Income Tax Act also. Now, friends, earlier what was happening is that during the course of assessment under section 143(3)(a), learned assessing officer, if he realizes, oh my God, this trust is violating the conditions where they were granted approval or registration. Approval in case of 1023C, registration in case of 12A, 12B, 12AB, 12AC, 12AA, those kind of trusts. There, if learned assessing officer detected something, he had to make a reference to the central government. That now they have delegated it to say, look, principal CIT is good enough to take such calls. You please make the reference to the principal CIT or the CIT. I will, of course, touch upon in the next two slides. But before that, one important thing is that, look, I talked about 11 subsection 2. We can make accumulation. Up to 85% I have to expend in this year. 15% I can carry it forward for the next 5 years. The conditions were what? I have to file Form 10 and that too within the due date of filing return. It's an intimation to the learned assessing officer that, look, sir, this amount I could not spend. Please, I am taking it forward. Next 5 years I will. And so therefore, till such time, the third condition is that I will invest in modes specified under section 11, subsection 5. Nationalized bank deposits, post office and all that. So that the fund is not misused. This provision is now, it was there for section 11, section 12, 13, that regime. They have now extended it to 1023C also. Well, in 1023C case, it was also there, but that form 10 and all that were not there. They have now brought that. So even parity, they have matched. Both sections are identical. Another important thing insofar as accumulation under section 11, subsection 2 is that earlier, on accrual basis, whether that application is allowed or not, open to interpretation. Now they have said it has to be on payment basis, meaning no good to say that in the next 2-3 years later, when I am getting the opportunity to actually apply that income, what I have accumulated 2-3 years before, I used to say, I am going to pay to so-and-so purpose, construction of hostel. I'm going to do that. But that liability, whether it was a constructive liability, I could have done it on accrual basis. They say, no, we want that money to be actually paid. So payment basis only you can claim section 11, subsection 2. Increased burden for trusts, increased responsibility on us as practitioners, because we are certifying that Form 10. Next slide, please. That's right. So I spoke about this earlier. The reference to central government for cancellation or resignment, that from central government, now it has come to principal CIT or CIT. Friends, it is actually proposed that if the principal CIT or CIT is noticing occurrence of one or more specified violations, friends, practitioners who are having clients in trusts, please, very important, specified violation they have defined, and that's very harsh. We have to be very careful. If one or more specified violation they have detected during the previous year, or they have received reference from the learned assessing officer under that 143 3 proviso I spoke about, where central government they had to go, that or some risk management strategy, meaning internal information, if they get something like that, then principal CIT or CIT has to follow a procedure prescribed, and which means he has to issue notice, show cause to the trust under 1023C or under the other regime 11, 12, 13, and he has the power to cancel or rescind the registration or the approval. What is a specified violation? Next slide. Where any income is applied other than the objects for which this trust was formed. If the trust is having profit and gain of business, which is not incidental to its objectives, or separate books are not maintained. By the way, one important development they have brought about now, I told in the beginning, maintenance of books of account. Earlier, it was not mandated. Now they have made it mandatory. Audit is also mandatory anyway, but books of account now have become mandatory. If the trust or institution in case of whatever the 1023C, they have applied any part of their income for private religious purposes or for the benefit of any particular religion or caste. If there is any breach of approval conditions, and most importantly, if any non-compliance with any other law is there, which is important for the purpose of achieving its object, again, that for the purpose of achieving its object, meaning I think everything we will say it is for purpose of achieving object only, but that stays here and it is open to interpretation. There could be litigation on this clause. But in any of these conditions, these are all specified violations. And if there is a specified violation, principal CIT or CIT has the power to cancel your registration, and for that the procedure is prescribed. Next slide, please. This I have already discussed. Whatever were the conditionalities under section 11 subsection 2, filing of form 10 within the due date of return of income and investment in modes specified under section 11 subsection 5, those things have now been extended to 1023C entities also. One important change they have made, and which is very important for all of us, is that if, see, we are eligible to accumulate such income under section 11 subsection 2, and also now for 1023C, we can accumulate it for 5 years. In 1023C, if you are unable to apply that income what you so accumulated within 5 years, in the 5th year it is taxable. Whereas in the case of 11, 12, 13, I told you there is an imbalance. In the case of 11, 12, 13 trust regime, charitable trust regime, we used to tax it in the 6th year succeeding or following the previous year in which that conditionality was expiring. They have now harmonized to say, and naturally, early collection of tax, preponement of tax, they said in the 5th year itself, if you are unable to expend that money, by the completion of 5th year, you will anyway come to know, please pay tax on that. All right, this is okay, academic, but then useful for some people in such situations. Exit tax, 2016, I think Finance Act had brought it. Meaning if a charitable institution wants to merge into another charitable trust, or if it wants to cease to be charitable trust, or if it wants to close down, vagara vagara, in such case, the question is what happens to the assets? There is a corpus sitting there. There are funds sitting. Who will pay tax on that? Earlier you didn't pay because corpus is not taxable. So in that case, exit tax mechanism was brought in. Now that was applicable to 11, 12, 13. That is now made applicable to 1023C also this year. Interesting, far-reaching amendments they have brought in. I think the most active contributor to this budget has been the section of the income tax department who are in charge of charitable trusts. Another important thing, which is day to day we are going to face this. Friends, during assessments we have seen of charitable trust, when an learned assessing officer chooses to disallow our claim of exemption under section 11, what he or she used to do, he used to tax the entire receipts. He will not allow me any expenditure, tax the entire receipts. That's not fair. Some of them used to allow, some of them not allow. There was no uniformity. Now they have brought in a uniformity. They have given a regime. What they are saying is that, look, we will give you benefit of expenditure, even in such cases, where from the income, expenditure of revenue nature, capital is by the way allowed otherwise, but not under this circumstance. So capital expenditure I will not allow. Income from corpus I am not going to allow. If you are spending money, expenditure from corpus, disturbing the corpus, I will not allow. Any amount you are spending and showing is application of income out of borrowing or loan, not allowed. So on and so forth. So they have given some regime like that, which means now there is a clarity. If the learned assessing of he has to follow the computation mechanism they have prescribed. Welcome step brings clarity. Of course, we taxpayers want to believe that no such disallowance should happen, but that's a part of life. Another important thing, they have, that the expenditure should be within India only, but in any case, it was within India. Another thing they have brought in now is that, next slide, please. I'm on the next slide now. So income in violation of the scheme of taxation under section 11, 12, 13 or 1023C now will be taxed at flat 30% rate, and no further loss or anything is set off possible. Nothing is possible there. One last slide. I am taking the 10th minute. So again, friends, this is a draftsman slip. Look at this, section 35(1)(a). What is that section? Which was saying that earlier when we made a contribution to towards SRA, Scientific Research Association and all that, or that university, vagera, vagera, we can claim benefit 125%, 115%, 200% earlier and all that, 200%. That provided the recipient was filing a statement which intimated to the government that these contributions have been received. However, there was an error, draftsman slip here. What they said was, if that statement is not done, then that research association will not get the deduction. Research association is the recipient. He is not claiming deduction. Deduction is to be claimed by the person giving the donation, companies and all that. But that they had made that slip there. Now they have sought to, that's not the intention of law, so they have rectified that. Friends, with this, a very good budget that they have brought, they have not made major changes, but at the same time, some far-reaching proposals they have brought about, as you can see, and understandable compulsion on the part of budget framers, because they need to augment revenue. COVID ke baad, there is a lot of need to augment welfare measures, and for that, and for defense and all, I told at the beginning, they need money. Where will that money come? So there was not scope too much to give much relaxation, much benefits, vagera vagera, as we entered into the budget. So what they have done, that on expected lines, they have not given too much, but at the same time, they have not taken too much from the taxpayer also. In some cases, they had to make some rationalization that they have done. But that's, even if that they don't do, how can that be an Indian tax department? Welcome budget. And with that, I conclude my analysis of the direct tax proposals. Thank you so much for a real patient hearing, friends. In case of questions or anything, etc., if right now this is the opportunity, we can. Otherwise, you can email to me through the organizers and I will come back to you within 48 hours. Thank you so much, and a real pleasure addressing all of you. Thank you, guys. Over to you, organizers.
Thank you so much, sir. It was a really thoughtful session. Do members have any queries? Okay. In case no queries are there, then maybe we can close the session now. So Karthik sir, thank you so much.
Most welcome.
There is one hand which is raised, I think. Any queries?
So thanks so much to all the people who have said.
Good evening, sir.
Yes,
this
please.
is CA Anil Chikodi from Kolhapur.
Yes, sir.
It was very nice lecture hearing you. I heard you for first time. I have one query about that cess which is now a clarification is given on cess, is it retrospective clarification?
Yes, sir. Right from FY 2004-2005.
Okay, since when the cess is introduced.
That's right.
Okay, because some of the high courts have pronounced that and allowed that in favor of assessee, allowing the expenditure as business expenditure. Now onwards, since it is a retrospective, you cannot able to claim this as a business expenditure now.
Yes, even earlier the intent was not, it cannot be, only because certain honorable courts entertained this view that cess can be claimed. What is the problem? Because of that CBDT circular in 1967. So that and all cuts no ice. They have now clarified that no, cess is not allowed. No, it was never allowed.
Yes. Thank you very much.
Welcome.
Karthik sir, there is one query in the chat box. It says that regarding the revision of returns after 2 years, that new
Updated return, updation of return.
Yeah, that. In what to be done in case of increase in income but no increase in total tax amount.
So this I also thought through. I think if the income is increasing, I think we should be able to file the update, take the benefit of updated return for the simple reason that, look, tax anyway is not coming down. Na? But there is an omission or mistake. That is the legislative intent. Honorable Finance Minister also said that. So I want to rectify that omission or commission, increase in income, but that is not offering any more tax. That's okay.
Correct. So any other queries? Okay. So it is my pleasure to thank you on behalf of the Thane branch of WRC of ICAI, Karthik sir. It was really a very practical, insightful and thorough session. You did not leave any stone unturned, as they say. And yes, there was nothing, I would say, that will be like preliminary for the members who have attended your session this time. Now, whatever their reading and secondary reading will be there, it will be beyond the primary touch that you have given. So thank you so much. And in case of any queries from members which is received, we will surely get in touch with you. So thank you so much.
Thank you so much. Thank you, everybody. Have a nice evening. Thank you.